everyone, and welcome to Money Show's virtual event. Next, we have two gentlemen with Estate Planning Specialists Incorporated, their CEO, David Phillips, and their president, Todd Phillips. Today, they are going to tell us about the 2020 Secure Act and how to combat the new stealth estate tax. Then at the end of the session, if there's some time, we'll take a few questions if you want to type them on the box on the right side of the platform. So David, please take it away.
Share. Okay. Great. Well, it's good to be here today. And actually, I'm going to be the only presenter today. Todd did the early morning session, and I'm going to be doing this one. So, but I want to talk to you today about the Secure Act and the ramifications of what it is, what it means to us as Americans. As you know, this particular, okay, hold on a second, we're not advancing here. The Secure Act actually was passed this past December and put into law on January 1st. And in reality, what has happened is the village has been pillaged. And I'm going to spend some time today talking to you about how your estate has been looted and your children and grandchildren have been robbed of the biggest asset in your estate. This is a life-changing event. It's actually something that really will impact any of us that have retirement accounts. And that's pretty much most Americans have some form of retirement account. So what does it mean? Well, first of all, it became law, as I said, on January 1st. And unanimously passed both the House and the Senate, and President Trump signed it into law on December 20th, effective January 1st. So we are now in the age of the Secure Act. The big thing, the big news, of course, is that the stretch is dead. And what do I mean by the stretch? Well, we'll talk about that here in a second, but just remember that the stretch is dead as a result of the Secure Act. Before we understand how the stretch is dead, we need to kind of understand the rules of engagement with regard to qualified accounts. As you know, any qualified account, 403B, 401K, an IRA, the money is put into the accounts and it's tax deductible. It's a tax deductible contribution. It continues throughout the life of the plan to accumulate tax deferred, not tax-free. That's the big difference. It's tax deferred. So someday taxes have to be paid. And that someday is when money is withdrawn. And the taxes are paid on they're totaled up of the amount that you withdrew for the year. And on December 31st, there's a total. So if you took $1 out in January, $1 out in March, $1 out in September, and $1 out in October, you took out $4. And on December 31st, that total is made, and you pay taxes on April 15th of the following year for the withdrawals that were made on that year at the tax bracket that you are on December 31st. And this withdrawal rule not only goes to us as individuals that have these accounts, but anybody that inherits those accounts. So there's a tax that has to be paid whenever we take out even just $1 from our IRA accounts. Now, if we take out money prior to 59.5, we actually have to pay a 10% penalty on top of that tax liability. So we have to be aware that there is that rule that's in place as well. Well, what did the Secure Act actually give us? Well, one of the things it gave us was the fact that we can now, that we can push our required distribution, the amount that we have to take out every year, to 72, from 70.5 to 72. It basically is just a little thing that they gave us, mostly for accounting purposes. 70.5 was a ridiculous time to start taking money out. It was too complicated. Now it's at 72, a little easier to calculate. The other thing that we have, it's still in place, that we had before, was that if a spouse inherits an IRA, the entire IRA is tax deferred to that spouse. So again, taxes are not paid when the spouse receives the inheritance from the the deceased spouse, but at her passing, when it goes to beneficiaries or whenever they take that money out, there will be a tax incurred. So the spouse gets the tax deferral, but when the money is touched, it's taxed. Now, there was a little side note that happened a few months ago, and that's the CARES Act. So it kind of came in and put into play to kind of trump a little bit, and I use that word facetiously, kind of trump the Secure Act. And one of the reasons why we've kind of stopped focusing on the Secure Act is because of the coronavirus. And as a result, this CARES Act was put into place, and it said specifically, okay, for this year, since everybody's hurting, assuming that everybody's hurting, that there will be no required distributions for 2020. And that includes not only us as individuals that have required distributions, but beneficiaries that are currently taking required distributions. They can have a hiatus or no RMDs for 2020. Also, if you have been impacted by the COVID virus, either personally with having the infection or losing your job as a result, you're able to take out $100,000 out of your IRA account, your qualified account, and that's penalty free. Now that again is if your employer allows you to do that, but it's penalty free, and that penalty would be for those that are 59 and a half. So it's important to understand that withdrawal is available to you penalty free if you're under 59 and a half. Not tax free. You still have to pay taxes on the tax bracket that you will be at the end of the year on December 31st. But you don't have to pay the penalty this year. And also, you can spread that tax liability out over 3 years. So that's what the CARES Act gave us in the middle of all this. Again, not tax avoidance, still have to pay the taxes. Well, okay, so then let's kind of go back to reality, because at some point in time, we're going to have with required minimum distributions again, RMDs again, and they will begin at age 72. So what have they done? Well, first of all, they did not change the percentages or the factors that are used to determine those required distributions. So how many of you that are taking RMDs right now love taking RMDs? Well, I honestly don't have a client that said that's really what they look forward to is their RMDs. It's kind of a nuisance, and it's income that they get that they don't really, sometimes they even forget that they're going to get the income, but it comes. And if you have $1 million IRA, the factor is a 25.6, which is about 4%, $39,000. And you can see as you go on through your life, the required distribution factor decreases, thus increasing the amount that you have to take out. The idea is that you will bleed out your IRA at some point in time because of required distributions. You will take out all of the money out of the account. Now, sometimes if you're earning good interest on your required distribution, you can actually kind of keep ahead of this gain. But for the most part, you're going to bleed this thing out over a period of time. Well, let's focus though on the non-spousal beneficiary, because that's really who I want to focus on. I want to talk about how this non-spousal beneficiary is treated with regard to an inherited IRA. So we know that the spouse receives when the first spouse passes away, they receive the IRA and it's tax deferred. But when the children and grandchildren inherit that IRA, that's when the impact occurs and life has changed, and that's where the village has been pillaged. The tax liability again is calculated on December 31st for any withdrawal, all withdrawals that were made. But the fact is that the 2006 stretch is totally dead. It's no longer available to us and to our beneficiaries. Now, if we were currently taking withdrawals through required distributions as a beneficiary, we get to continue that. But going forward, the stretch is dead. And all IRA and Roth IRA money must now be distributed within 10 years. So it's called the 10-year rule, and we are now in the 10-year rule period of life with regard to our qualified accounts. And it's something that we have to be aware of. We have to know what the rules of engagement are. Let's talk about the logic behind this law, though, that on how it all came to be. First of all, qualified accounts were never intended, and qualified accounts includes IRAs, 401ks, they were never intended to be inherited by our children. That wasn't the intent. They weren't not intended to be retirement accounts for children. And in fact, that's why they call it retirement accounts, an individual retirement account. It's our retirement account, not our children's retirement account, not our grandchildren's retirement. We were supposed to spend the money. We were supposed to use it all. And we haven't really done a very, very good job of that because we're hoarding the money in what I call the Midas syndrome. And why are we hoarding it? Why do we hoard this money? Well, first of all, for many of us, we can't keep it from growing. I mean, we have, you know, the market was going crazy. In January, it was amazing. COVID hits. March, the market plummets. What's happened to the market since then? It's back up. Even in the face of the worst pandemic that we've had, or so the acclaimed worst pandemic that we've had, we still can't keep our money from growing. So that's one of the reasons why we hoard it, just because we can't stop it. But the other reason why is because of the number one fear of retirement, and that is longevity. We continue to live and live longer and longer lives, and as a result, we don't want to run out of our money. Well, the longer we live and we have this longevity, the more likely we're going to experience a market downturn. It will eventually go down the longer we live. We'll probably experience inflation, deflation during that period of time. We certainly are, I believe, going to experience increase in taxes, and a loss of cash flow is possible. So those things are going to happen to us, but one of the things that we sometimes forget about is the long-term care event. And each of us have a very, very high potential to have a long-term care event. In fact, 72% of all Americans that are over 65 will have a long-term care event. So these are things that we have to plan for. And one of the reasons why we continue to hoard our IRA money, because we just don't want to run out in case of any of these things that happen. But hoarding or storing our IRA is actually playing right into Uncle Sam's hand. And your IRA simply becomes an IOU to the IRS. As the Secure Act was implemented, though, it actually again plays into that hand, and it accelerates that distribution to our non-spousal beneficiaries, increasing the tax revenue. So instead of allowing the kids to inherit the money over a longer period of time, they inherit it, and it has to be taken out over that 10-year period of time. Again, back to the logic. In 2014, the Supreme Court ruled that the non-spousal inherited IRAs are not retirement accounts because they were not created by the recipient for the purpose of retirement. So they're defined by the Supreme Court as not retirement accounts. They're not for the beneficiaries. This is non-spousal IRAs. But the problem is that 83% of all retirement accounts are passed to a beneficiary. So while the IRAs, inherited IRAs, are not intended to be retirement accounts for our beneficiaries, 83% of our accounts are passed to benefit. We're not spending it, we're hoarding it. And then when our children inherit this money, most of it is gone within that first year. And I'm not really sure that that's our goal. I don't think that's the goal, for our money to be used up that fast. Now, you could say, well, most IRA accounts are small, and therefore they are used for down payments on houses, or pay off your mortgage, or pay off your debt. I get that. But I've seen some IRAs recently that are in the tens of millions of dollars. And those accounts are not going to be, we don't really want those IRA accounts to be gone in 1 year. That would be prudent. Now, in addition to pushing the RMD factor to 72 from 70.5, the Secure Act gave us a couple of what I call doggy bones. Probably the one that you would all know is that now we can continue to make IRA deposits of up to $7,000 a year, no matter what our age is. In the past, that was capped out. There's a couple of other little bones here, as you can see, in the student debt, and we can take out $5,000 if we have a baby. Well, at 70 years old, probably not a likely situation for us. One that I'm looking forward to that hasn't occurred is that we're going to be able to have income annuities inside of our retirement accounts, and this will be pretty important because this will allow us to change our cash that's in those IRAs and 401ks into income that is guaranteed for the rest of our life. So we're looking forward to that one. That'll be a change that'll be forthcoming, and we're looking forward to it. Now, with regard to the non-spousal beneficiaries, there's a few exceptions to that. As I said, the first one is surviving spouses. Of course, they get don't have to pay taxes right now when they inherit it, and the new rules do not apply to those that, as I said, are currently receiving IRA distributions from prior inheritance. Minor children, until they reach the age of majority, they can stretch it till they become of majority, depending on the state they live in. Disabled, chronically ill, and individuals not more than 10 years younger than the owner, like my brother Jay, who's 3 years younger than me. So those folks that inherited, they can still stretch the IRA, but everybody else has to. Everybody else, it's the 10-year rule. My biggest question about this 10-year rule is, okay, so I have this IRA. Let's say the IRA is a $1 million IRA, and I'm going to pass this to my 2 kids. Who is going to guarantee that my children take this money out over 10 years? If they don't take it out, they're going to have the 50% penalty, which is called the too little penalty, and we don't want that either. So the money needs to be gone by those 10 years. Who's going to make certain that the distribution instructions are honored? You? Not likely, because you're not going to be around to do it. The beneficiaries? No, because they'll take it whenever they want. The custodians? No, they've told us, the custodians, the Schwabs, the Fidelities, Vanguards, they've told us that's not their job. Their job is to accumulate, not to distribute. A conduit trust cannot be used anymore, so you have to scrap that. The answer is an insurance company annuity, or what we call the IRA Dynasty Trust. So those things will ensure and guarantee that the money will just be distributed the way you want it to be distributed. Now, to be honest with you, most folks will be taking this money out over chunks. Most beneficiaries will take it in pieces and chunks. But the fact is it all has to be gone and out within the 10 years. Well, all of this is explained in the special report, the Bombshell Battle Plan, that you will all receive by filling out the evaluation form here at the end of the talk. That it's available on our portal. Well, let's look at the old stretch rules here. This is how it all laid out. This was what we had, the factor, and the factors were in here, a 40-year-old inheriting $1 million, and they ended up at the end of the day with $1.5 million. Taking out this withdrawal that came out, this was the old factor that they took out if they stretched it. It was a nice program that was there. With the new 10-year rule, you can see that they have to take, if they took it out equal and they earned 7% on this account, they would end up having to take out $133,000 of that $1 million IRA account over that period of time. And that $133,000 would be added to their top line. So it adds to or increases their taxes because it increases their tax liability by $133,000. This is if the account's $1 million and one child inherits it for that period of time. This is the worst part of it, though, because at the end of the day, there's nothing left. And you could say, well, I'll just wait and I won't take anything till the very end. But that's actually the worst way to do it. And your tax implications are huge at that point in time. So you really don't want to do that. If you look at a side-by-side comparison to the three options, the old stretch, which you don't really have an option now, the 10-year and the withdrawal, you can see that the tax liability is significantly greater if we wait till the very end of the account. But so the biggest obstacle I see is that there's nothing left, whereas before we were able to have quite a bit left here in the IRA account. So what are the solutions? Well, we have about 10 minutes left that I can talk to you about the solutions. And most of the solutions are handed in the special report, the Bombshell Battle Plan report, but I wanted to cover just a couple of them. First of all, we need to spend it first, and we need to spend it fast. That money should be, our IRA money should be the money that we take out of the account as fast as possible. We could transfer it to a charity. We can still use the $100,000 contribution every year, count it toward our RMDs. We could convert it to a Roth, and we're going to talk a little bit about that Roth conversion idea here in a second. Or we can convert it to what I call the Secure Act Solutions strategies. There's actually several of these strategies. So let's talk about converting to a Roth. If we do convert, we have to pay taxes in the year that we convert. And the taxes are paid as ordinary income of that year based on our income tax bracket. But a Roth conversion creates tax-free accumulation, tax-free distribution, and tax-free inheritance. You want to convert during the sweet spot, which is 59.5 to 72. And you can play what we call bracket bumping or tax bracket management game. Because of the Tax Cut and Jobs Act, with the new tax bracket that we have, we are at the lowest tax brackets we've seen. And so we can not only use tax offsets and deductions, we can play this tax bracket management game. And you can see here that we can take up to, as filing jointly, $326,000, and our top bracket would be 24%. The tax actually would be about $30,000 on that. And so the idea is we should try to get up to that maximum tax right here, income, without paying an additional tax of 32%. It doesn't sequentially make any sense. That's what it is, and that's what we're scheduled to have. But the problem is we have to consider state income taxes as well. So you might want to move during conversion to Florida, where they don't have any income tax, and do your converting then at that point in time. But we're running out of time. Right now we know that we have at least 4 months left here of this current brackets. We don't know exactly what's going to happen in November. It's anyone's guess at this point, I believe. If Trump continues and retains his presidency, we'll have another 52 months of that tax bracket management that we could use. If he doesn't, I think all bets are off. So we want to make sure that you take advantage of that tax bracket management now and do the Roth. But a Roth is only worth what a Roth is worth. So you need to look at I believe, the IRA Holy Grail, the perfect conversion tool, which is the Secure Act Solution Strategy. And that includes the RMD leverage strategy, the wealth creation strategy, the family bank strategy, the Roth unrolled strategy, the IRA reboot strategy, and the twist of charity on your IRA. Those are all explained in the Bombshell Battle Plan special report. You get that by filling out the evaluation form at the end of this, and we'll send that to you at no cost. Let me give you an example of two of those strategies, the wealth creation and the family bank strategy. We have George and Sarah. They're both age 72, in good health, $1 million IRA. Their required distribution, $39,000. And by the way, just because they don't have an RMD this year, they still should take the RMD out for purposes of doing this strategy. And that gives them a net at 25% tax bracket of $29,000. They're earning 6.47 with a 1% investment fee, 5.47 net. And this is the way it all breaks out. So let's just say they continue to make that same deposit every year into a Roth. Well, the first year, the Roth is only going to be worth what a Roth is worth. But the wealth creation strategy is going to be worth $1.5 million. What is it? It's a joint and survivor life insurance policy that we acquired by depositing $29,000, our net our RMD, into a joint and survivor second to die policy. And that creates $1.5 or $1.6 million of instant and perpetual liquidity. You can see that even as the IRA grows, the Roth IRA grows through the years, it never ever, I mean, at 92 and 20 years from now, when George and Sarah are 92, it's worth $1 million. Our wealth creation is worth $500,000 more than that, and it has been the entire period of time. This money is paid out tax-free to our beneficiaries, and so they're able to get way more money than they would in any other vehicle, especially in the Roth. Even though the Roth is tax-free to them, they still get more money. And they could do the family bank. Family bank, why would I do that? Well, because my tax-free wealth creation, my account value is going to be greater with the family bank. And so these ideas are all explained in the special report. Let me look at this Roth on Roids strategy, which I really think is applicable today, because here's our tax liability. We looked at the 10-year rule over the 10 years. So where am I going to get the money to pay that tax liability? Well, I'd have to take it out of my IRA. Well, not so fast. You could do the Roth on Roids strategy and purchase a $500,000 joint policy that's tax-free. It's going to come to the kids. And over that 5-year period of time, through the Dynasty Trust, if you want, they take that money out of the insurance policy to pay the tax liability. And this is assuming they take it out over 10 years. As I said, most people are going to take it out in chunks. And the IRA is transferred 100% to your family, totally intact. If you do this, you're going to pay the taxes not out of the IRA, inherited IRA. You're going to take it and pay it out of the insurance policy that you acquired, the joint policy. I love this concept here. This is a 60-year-old group, husband and wife, and they're in good health. They put in $9,000 a year for 10 years to acquire the $500,000 worth of insurance. They do it now. They do it while they're young. They're building up significant cash value. The internal rate of return is 11% on that $9,000 over 10 years, or 5.5 to 1 return on that, guaranteed to them to come into play and create that $500,000 of tax-free money that they can use to replace what Congress just took away with the Secure Act. And that is really the bottom line of the Roth on Steroids strategy. And you can actually include in that, if you want a long-term care plan, you can add that to this plan. So you can have a three-in-one. You can have the insurance, the cash accumulation tax-free, accumulating tax-free just like a Roth would, and a long-term care plan. That would be equivalent to $500,000 of benefit to you should you get into a situation where you can't perform 2 of the 6 activities of daily living or you're cognitively impaired. The last one I just want to share with you quickly is what we call the Secure Act stop and go strategy. So let's say I'm shifting around my income and I'm playing this the tax bracket management, and this year I have room for $40,000. But next year I don't have any room, and the next year I don't have any room, or let's just say I don't have any income for those years. You can get the plan started, get $1 million benefit, and at age 60, and then fund it again in year 4 and year 7, and so you have that stop and go strategy. And I really like that. It allows for flexibility for full tax bracket management. The IRA reboot, cool idea. You have a $500,000 IRA. You have Irvin, age 64. And he's going to take this and he's going to convert it over a 5-year period of time. He's going to earn some interest on that account, and he's going to put it all into the family bank policy. But he's going to do that over a number of years. He's going to do it over 5 years. In year 2, he actually takes the money from the cash value, borrows it from the cash value from the insurance company using the cash value as collateral, and he uses that to pay the taxes. So in essence, what he has is he has the insurance company paying his tax conversion. That's called the IRA reboot strategy. And
David,
what that does is that provides $1.3 million of tax-free estate value for his family. So what were you saying, Greg?
I was just about to say we're out of time, so it looks like you're
Okay.
about to go to the closing slide. Go ahead and do that.
We're out of time, and if you want a complimentary consultation with me or Todd or Rick Durfee, who is our lead counsel, call the 888-892 number here, or email us at info@epmez.com, or go to our website, get on that way. We would love to talk with you, share some ideas with you. You can also sign up for the Retirement Planning Solutions Suite at the end here, and that will actually get you into the queue for us, and we will have your attention, and you will have our attention, and we will attend to you and make sure that you understand how to convert from Roth to the IRA concepts, the IRA solution strategies, and analyze your estate, and also explain to you what the reboot ideas are that you can implement. So it's been a pleasure talking today. We have the Bombshell Battle Plan report that's available for anybody that fills out the, when you fill out the evaluation form. Thanks so much. This went very, very fast, and have a great day.
Thanks a lot, David. Great presentation, and everybody, thanks for listening in.